Welcome to 5 in 15, 5 industry insights in 15 minutes from Marshall and Stevens. My name is Jennifer Simmonson. I'm a director of real estate at Marshall and Stevens. Today, we're discussing the impact of the One Big Beautiful Bill Act on commercial real estate activity, as well as a few other items. I'm joined by none other than Matt Pourcho, Executive Vice President of Investment Properties and Capital Markets at CBRE. Welcome, Matt. Thanks for coming on.
Yeah, hey, thanks for having me.
Let's get started and kick it off with the Big Beautiful Bill catalyst, question number one. Let's discuss the impact of the One Big Beautiful Bill Act on commercial real estate activity in your market. And from your perspective, has the permanent restoration of 100% accelerated depreciation changed the math for investors, particularly those looking at value-add industrial or office properties?
Yeah, no, absolutely. The math is a game changer. The problem we have right now is most people don't even know what the math is. So if you're a high net worth family and you've owned a property, you inherited a property, you're just collecting cash flow. No one knows the opportunity cost for holding that property, not doing a 1031 and utilizing that accelerated depreciation. But that has definitely stimulated and helped our business a lot, actually, since that passed last July. Bringing that back to 100% versus it was phasing out on its way down to zero with the last administration. The math is pretty powerful when you're able to purchase a new property, or if you're 1031 exchanging and using leverage any greater than your basis you're trading from, and being able to accelerate that is substantial. In fact, it's so substantial, I would say our average client is not paying any federal income taxes right now for anywhere from 3 to 5 years. Now, everyone's tax situation is completely different.
Right.
But it's to have that huge write-off year one, and even if you don't use it, it sits on the shelf as a loss carry forward for future years. So it's a phenomenal tool to use the cost segregation and accelerate that appreciation for owners of real estate.
Do you have for instance of one example that you could give?
Sure. It's fun. We probably are averaging 2 to 3 presentations a week right now, just utilizing the new Big Beautiful Bill and cost segregation. We provide our clients with a trade-up analysis that shows them, here's the cash flow you're making today. And if you were to 1031 and sell, here's the cash flow you would make that's substantially greater. Oh, and by the way, because if you use cost segregation and you accelerate the depreciation, the write-off is so large, you're probably not going to be paying federal. Well, we can actually show how many years it is, 3.7 or 2.3. We just met with a family that's owned an apartment building. Even though my team, we specifically don't sell apartments, other teams bring us in to help walk them through the trade-up analysis, and then we'll help place their capital across the country once they do sell. And we met with this family. They own this apartment building since the 70s. There's all these problems going on in the neighborhood and all these high rises going on around them. And then they have all this deferred maintenance. So they have an opportunity to sell. And they were like, well, we just don't want to change. But what would the math look like? And their current income was $17,000 a month net. And we were if they 1031, they could go into something at like $47,000, so $17,000 to $47,000.
Wow.
They're not paying federal income taxes. I think in their analysis it was like 3.7 years. We're closing another deal this week, actually. We're closing the first 2 deals this week and then another 2 next week of a lady who owned a property here in Oceanside. She was making about $18,500 a month.
Okay.
And she moved to Texas, and so she wanted to, we showed her the math. She was like, why would I ever sell? I have a 6 or 7 year lease with my tenant. This is, I'm just set it and forget. This is my retirement. We're like, well, have you heard about the Big Beautiful Bill? And if you use cost segregation and the write-off and put your equity to work conservatively. So we showed her a model. She's like, this can't be true. Well, her CPA confirmed it. That's a great thing. It's like, commercial real estate brokers, people could think, we're just brokers trying to get a deal done. We're like, talk to your CPA. Look at this analysis. This cost segregation, this is black and white. It's in the tax legislation. You can write it off legally. There's no funny games being played. And so on that particular client, $18,500, we're taking her to about $45,000 a month.
Wow.
Yeah. And again, she'll have longer term lease, bigger credit tenants. Like it almost sounds too good to be true, right? Like people just don't do the math. And I think that's the problem we're having right now is we're seeing, well, it's not really an opportunity that keeps us in business really, is educating clients, acting like a financial consultant. And that's, quite frankly, one of our intros into a cold call to a client. is talking about the big beautiful bill and using cost segregation. So it's a game changer.
All right, Matt, question number 2. Let's talk about strategic cost segregation. With 100% bonus depreciation, now a permanent fixture rather than a phasing out benefit, how essential has the cost segregation study become in the sales process? Are you seeing sellers proactively provide cost seg studies to highlight the immediate tax shield available to a potential buyer? Or is that something you and your team step in to help with?
So that's something we actually bring to their attention. So we started incorporating in our marketing process to say, if you buy this building, specifically look at it like an owner user, a vacant building. So instead of paying rent, in the high rent district or any rent, it doesn't matter if it's $2, $3, $4, we're generally finding it almost impossible to beat up the numbers to where it's cheaper to lease than own. In fact, it's if you come up with the down payment, it's cheaper to own than lease because of that cost segregation. Again, that write-off is so large that it wipes out pretty much your occupancy costs for quite some time and helps really minimize the out-of-pocket and capex a company is going to be spending. So I just had a tour the other day with a local company here in San Diego touring one of our vacant buildings, and they're like, "Look, we're trying to shelter $40 million of net income." I was like, "Well, welcome to real estate." That you can accelerate all year one, and they're leasing space. So why not buy a building, pay yourself, don't pay your landlord's yacht gas, and control your destiny, have your appreciation, not their appreciation, then use cost segregation and accelerate the depreciation, and the numbers just speak for themselves. That's the best part. Is it's just math, and it's taken the whole broker talk out of it. It's not just lip service, it's real math. So we're incorporating it, and we're proactively mentioning it in everything we do because it's so vital.
So this effectively, is this impacting every single sale that you and your team are touching right now?
Pretty much. I would say over 80% of them. I mean, it's our job. I couldn't sleep well at night unless I brought it to every client's attention. And I will tell you, probably 90% of them have no idea that it changed with the big beautiful bill. So it's an educational process that we're incorporating not only in our marketing materials, but in our calls and conversations with every buyer and every seller.
Yeah, sure. I mean, you spoke about this at a prior event. That's how I found out about this. And that's why I wanted to bring you back on. That there are a lot of investors, owner users that have no idea that this is going on. And I think it's so critical that they get this information out. So glad you could talk about it today. All right, Matt, question number 3, investor trade-ups with cost segregation. So tell me, are investors trading up, and how does cost segregation play into their investment strategy?
Yeah, they're trading up now, and cost seg is everything. I mean, it still makes a lot of sense to trade up without cost segregation, in my opinion, but cost segregation is the octane to the fire. It is the octane that puts gas on the fire and really accelerates that depreciation. So it really allows us to show a client, if you were to 1031 and you were to trade up per se, that additionally sell building for $5 million, you buy a $10 million building, that additional the new 5 to 10, and accelerate that. Again, that is the game changer for any commercial real estate owner on a new purchase to enjoy, if not zero to minimal federal income taxes to shelter that, given the large write-off. And again, most of our clients, the write-off is so large, it sits on the shelf for future years, known as a loss carry forward. Again, they confirm that with their CPAs, and we tell them, hey, confirm everything your CPA. CPAs are our biggest advocates. They're like, yeah, this makes sense. They're not telling you just to go do something for fun. Like, the math is the math. Right. So I will say the trading up with cost seg is everything. I mean, we're pitching that to everybody right now.
So just as a follow-up to that, so obviously there's been some hesitation, buyers, investors, because cost of capital has been elevated, right? But this is really kind of erasing that and increasing activity. Is that fair to say?
Yeah, and like a rising tide lifts all boats, right? So cap rates for industrial could have been 3.5% to 4%. Now we're seeing 5.5% to 6%. But then again, they're going to be buying something at 5.5% to 6% or 6.5%. So it kind of all fluctuates together. So that makes the trade up and using the cost seg make a lot more sense, because it works in down markets, it works in up markets. And like I said, a rising tide lifts all boats. So it's all fluid on what they sell and what they buy.
Question number 4, Matt, market sentiment and the dry powder. I don't know, same thing, gasoline you were talking about. Office vacancy remains a challenge in almost all CBDs across the country. And yet sales volume actually spiked in late 2025 in some markets. Is this activity driven more by distress pricing, or are we seeing a fundamental shift where tax motivated buyers are finally deploying their dry powder, gasoline, whatever you want to call it, to capture the long-term upside?
Yeah, that's a great question. First, from a fundamental, we're spoiled in San Diego because we've led the nation in office fundamentals. So we didn't see the downturn like all the other markets, primarily because our demographics. 90% of our companies in San Diego are 15 employees or less, architects, CPAs, attorneys, engineers, et cetera. So only one of our 29 submarkets, downtown San Diego, really experienced that major downturn that you hear about the headlines about buildings being fire sold. That dumpster fire has already been put out. Over 80% of our buildings have already traded downtown, and not much more is really coming online. So that's kind of the headlines will stop with that. But the suburban markets are phenomenally healthy. In regards to private investors and just investors in general, the cost segregation is really important for an office building, specifically because there's so many improvements that you can accelerate the depreciation on versus like a warehouse building. So if, let's say you buy a warehouse box, there's really not too much to depreciate there compared to an office building. You have all the walls and all the hallways and all the restrooms and light fixtures and everything, right? So there's just so much more to accelerate the depreciation on. And I think buyers we are seeing a pretty decent uptick in office sales in San Diego County, particularly because getting that message out about the demographics. And we've remained very healthy here throughout the recent pandemic, where we didn't see a blip. We sold a building a year ago with 27 tenants, with a 4% office vacancy market, and not one tenant left in 7 years. I just closed another deal last week to where there's 12 tenants, not one tenant left in 10 years, and it's been 100% leased. So wow. You hear this, you're like, whoa, how is that possible? Again, the media and the headlines you read is like office is dead in America, but no one peels back the onion to understand, okay, well, San Diego's 29 submarkets, only one has been in trouble. The rest have been extremely healthy given those demographics. And the recent sales we've had have been 1031 exchange buyers trading out of other properties and buying office, because you can buy an 8% cap rate, for instance, which is the highest cap rate, in the major food groups compared to like industrial or apartments where you make a much smaller return, and you're getting debt at 6%. So you're making almost a 10% return, 9.5 to 10%. Then you cost seg that, and it's like, game changer. Where else do you find a nice double-digit return with no federal income taxes or minimal taxes for X amount of years? Because you can accelerate the depreciation. So we definitely incorporated cost seg into our marketing of the office buildings, but we are seeing that really important for office buildings, and cost seg is a huge, I would say, fundamental growth driver, to office selling, and especially more so on the private side than anything.
All right, let's get to question number 5, the great price disparity. So Matt, there is a significant delta right now between what an owner user is willing to pay versus an investor. And previously, when I saw you speak at another event, you discussed this relative specifically to the San Diego office market. Just wondering if you can walk us through that valuation gap that you're seeing and why a business owner is often able to justify a much higher price per square foot than an investment buyer would be today.
I think first why we're seeing that disparity and that large gap or the large delta, because of cap rates on the investment side have gone up so high. So an office building in San Diego, pre-COVID, pre-recent pandemic, we used to trade at called a 6.5 to a 7% cap rate. Now we're seeing 8 to 8.5, and now eventually, I think right now we're starting, and it's dipping downwards, so getting back towards that way. But you went from a 6.5 to 7 to 8.5, and so values dropped significantly. As I mentioned before, like rising tide lifts all boats. Well, if the tide goes out, all the office cap rates went up around the country and valuations went down. The owner users look at sale comparables of other owner user office buildings, which are kind of a different category, different subset of sale comparables, if you will. And then I think the cost segregation is even more vital to an owner user, because what they're doing is they're saying, okay, I'm paying $5 or $2 a square foot, whatever the number is, in rent. Right. Okay, I can write some things off in a tax, and we have a lease versus own analysis that shows that in all of our marketing materials. But if the $2 eventually goes to $1 due to write-offs and whatnot, and they buy a different building, With cost segregation, there's generally hardly any occupancy costs we're finding for several years because there's such a massive write-off on
Okay.
purchasing that building.
Okay.
So, and you have the 10% down component. So the demand has been really good as I think owners are meeting with their CPAs and they're considering when a lease is up with rents still pretty high, do I want to be paying rent anymore or do I want to control my destiny, have this massive tax write-off, help shelter income and buy a building? So they're not looking at the sale comp. Oh, the building downtown traded $100 a square foot. I should pay 100. Well, no, like this submarket to owner users is traded at $400 a square foot. In fact, we're selling office buildings now to even condo developers. Like the condo development craze is back, and we'll sell a building at 225 a foot, and they already have offers at 600 a foot after putting a condo map on it, and they're making that delta, that profit, because the small CPA, the dentist, the attorney is like 1,000 feet, 2,000 feet, and the math is a no-brainer when you purchase versus rent, especially over a 5, 10, 15-year period. If you're going to be in business for 20 years and you look backwards and see how much rent you've thrown away versus owning your own and you get the tax benefits and appreciation, depreciation with cost seg, et cetera, it's a no-brainer.
Awesome. Thank you so much for your time today, Matt. I'm super excited about what you shared today, and I hope we get the word out to as many people as possible. Thank you so much. Take care.